What happens when we reach the age that we have to take it easy? Retiring in your 50s is a good idea if you ask us, but what retirement options should you have? By understanding your retirement plan options, you'll be better able to maximize your benefits and truly attain the retirement you desire. So, what retirement plans can you consider right now? What benefits await you in each one? You're here to find out. Welcome back to our fiery channel. This is Fire. Here we bring you wealth tips, financial advice, cryptocurrency information, and updates on the financial world that you should definitely catch up with. If you haven't already, make sure you subscribe and ring that bell to get notified every time we upload a new video. We make sure we only bring you the best content. Well, share your thoughts in the comments below and watch till the end to find out the finest retirement options for a fabulous life in your 50s. IRA Plans. An IRA is a useful retirement plan established by the United States government to assist workers in saving for retirement. In 2022, individuals can contribute up to $6,000 to an account per year, while workers over the age of 50 can contribute up to $7,000. Traditional IRAs, Roth IRAs, spousal IRAs, rollover IRAs, SEP IRAs, and simple IRAs are among the several types of IRAs. A traditional IRA is a tax-advantaged account that allows you to save for retirement while receiving considerable tax savings. Anyone who makes a living can contribute to the plan with pre-tax income, which means that the contributions are not taxable income. These contributions grow tax-free in the IRA account until the account holder withdraws them at retirement. When the money is withdrawn, it then becomes taxable. Withdrawals made earlier than the allowed age of retirement may subject the employee to additional taxes and penalties. On the other hand, a Roth IRA is a newer version of a traditional IRA that provides significant tax benefits. Contributions to a Roth IRA are made after tax dollars, which means you've already paid taxes on the money that goes into the account. In exchange, you will not be taxed on any contributions or earnings that are withdrawn from the account at retirement. A Roth IRA is a fantastic choice because of its significant tax advantage, and it's an excellent choice if you want to grow your earnings for retirement while keeping the tax man out of it. IRAs are typically designated for employees with earned income, but the spousal IRA allows the spouse of an employee with earned income to contribute to an IRA as well. However, the working spouse's taxable income must be greater than the IRA's contributions, and the spousal IRA must either be a regular or a Roth IRA. A rollover IRA is created when you move a retirement account, such as a 401k or an IRA, to a new IRA account. You roll the money from one account to the rollover IRA while still taking advantage of the tax benefits of an IRA. A rollover IRA can be established at any institution that accepts it, and it can either be a normal IRA or a Roth IRA. There is no maximum amount that can be transferred into a rollover IRA. The SEP IRA is constructed similarly to a traditional IRA, except it is intended for small business owners and their employees. This plan can only be funded by the employer, and contributions are deposited into a SEP IRA for each employee rather than a trust fund. A SEP IRA can also be established by self-employed individuals. Lastly, we have the simple IRA. Because all employees receive the same benefits, the simple IRA avoids various non-discrimination standards. Even if the employee does not contribute to his or her own simple IRA, the employer has the option of making a 3% match or a 2% non-elective contribution. Solo 401k Plan. The Solo 401k plan, also known as a Solo K, Uni K, and One Participant K, is intended for a business owner and his or her spouse. Because the business owner is both the employer and the employee, firms can make elective deferrals of up to $20,500 plus a non-elective contribution of up to 25% of remuneration for a total yearly contribution of $61,000, excluding catch-up contributions. It's more difficult to set up, and if your assets surpass $250,000, you must file an annual report on Form 5500SE. This strategy will not work if you intend to expand and add new personnel. When you hire new employees, the IRS requires that they be included in the plan provided that they fulfill the eligibility criteria, and the plan will be submitted to non-discrimination testing. The Solo 401k also outperforms the popular SEP IRA. Traditional pensions. Traditional pensions are a sort of defined benefit or DB plan, and they are one of the simplest to maintain because they require so little of you as an employee. Employees fully fund pensions, which pay a fixed monthly income to workers upon retirement. DB plans, on the other hand, are on the endangered species list since fewer firms are offering them. According to Willis Towers Watson's research, only 14% of Fortune 500 businesses offered pension plans to attract new employees in 2019, down from 59% in 1998. Why? DB plans necessitate the company fulfilling an expensive pledge to finance a sizable sum for your retirement. Pensions, which are normally paid for life, replace a percentage of your earnings based on your tenure and salary. This benefit addresses the risk of running out of money before you die, often known as longevity risk. Because company pensions are becoming increasingly scarce and precious, leaving the firm might be a huge decision if you are fortunate enough to have one. Should you remain or should you leave? It depends on your employer's financial strength, how long you've been with the company, and how near you are to retiring. You should also consider your job satisfaction and whether there are better chances available elsewhere. What do you think so far? Let us know in the comments. Before revealing the second half of this video, please make sure to hit the thumbs up button and share FIRE with your friends. Spread the good news of financial independence and success. The Federal Thrift Swift Savings Plan. The Thrift Savings Plan, or TSP, is similar to a 401k plan on steroids, and it is available to government employees and members of the uniformed forces. Participants can choose from 5 low-cost investing options, including a bond fund, an S&P 500 index fund, a small cap fund, and an overseas stock fund, as well as a fund that invests in specially issued treasury securities. Furthermore, federal employees can select from a variety of life cycle funds with various target retirement dates that invest in those core funds, making investment selections very simple. Federal employees can benefit from a 5% employer contribution to the TSP, which comprises a 1% non-elective contribution, a dollar-for-dollar match for the following 3%, and a 50% match for the next 2% donated. As with all defined contribution plans, there is always the possibility that your account balance will be negative when you retire. You must still decide how much to give, how to invest, and whether or not to make the Roth contribution. However, it makes a lot of sense to contribute at least 5% of your salary in order to receive the maximum employer contribution. Cash balance plans. Cash balance plans, like defined benefit plans, are a type of pension plan. However, rather than replacing a set percentage of your income for life, you are promised a particular hypothetical account balance based on contribution and investment credits, like annual interest. According to Littell, a standard design for cash balance plans is a company contribution credit of 6% of pay plus a 5% yearly investment credit. The investment credits are only a promise, not actual contribution credits. Assume a 5 return on investment or investment credit is promised. If the plan assets grow in value, the employer may reduce contributions. In fact, many employers that wish to get rid of their traditional pension plan convert to a cash balance plan since it gives them more control over the plan's expenditures. It continues to offer the promised benefit, and you are not required to contribute anything to it. In addition, if you decide to change jobs, your account balance is transferable, so you'll get whatever the account is worth on your way out of the door of your previous work. Cash Value Life Insurance Plan. Some businesses provide insurance vehicles as a perk. There are 4 kinds of lives: whole lives, variable lives, universal lives, and variable universal lives. They give a death benefit while also accumulating cash value, which can be used to supplement your retirement needs. When you withdraw the cash value, the premiums you paid, your cost basis, are deducted first and are not taxed. It mitigates several hazards by providing either a death benefit or an income stream. In addition, you will benefit from tax deferral on the increase of your investment. If you don't execute it correctly, if the policy lapses, you end up with a large tax payment, Littell explains. When you buy it, you are more or less bound into the strategy for the long term, just like with other insurance solutions. Another concern is that the products do not always perform as well as the images suggest. These products are intended for more affluent individuals who have exhausted all other retirement savings options. If you have exhausted your 401k and IRA contribution restrictions, you might want to consider investing in this sort of life insurance. And that's the end of the video. In any event, the best way to ensure your financial future is to fill up your accounts and save the maximum legal amounts each year. The earlier you begin investing in your future, the more your money will be able to compound, and these tax benefits will help you collect money even faster because you won't have the additional drag of taxes. Which retirement option would you like to go for? Let us know in the comments. Alright guys, we're wrapping up today's video, and we hope you enjoyed today's topic. Thanks for visiting our channel. This is FIRE, your channel on wealth tips, financial advice, cryptocurrency information, and updates on the financial world that you should definitely catch up with. If you like this video, make sure to hit that like button and check out more videos like this one on the FIRE channel. Thanks for watching, and of course, see you in the next video.